Good morning, Bitcoiners. Hello, and welcome back to your economic calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Monday morning, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, September 27th, and we have a very special episode for you as always. In today's issue, we're going to start by looking at the Chinese ban and build model. We're going to look at how they've used this in the past and why it may or may not work for Bitcoin and cryptocurrency. Second, we're going to look at the Fed, who continues to move closer to tapering its purchase program, and we're going to look at how that could impact markets in general. And last, but certainly not least, we're going to look at Twitter, who added Bitcoin Lightning tips and what this could mean for Bitcoin adoption going forward. So grab your coffees. It's going to be a great one. And before we get going with today's show, we wanted to announce our interest rates for our savings accounts as of October 1st, 2021. So as you can see in the back of your screen, our interest rates for our Bitcoin and our USDC savings accounts will remain unchanged as of October 1st, 2021, with 6.1% APY for the first two Bitcoin and an interest rate of 2.25% APY for balances over 2 Bitcoin. And the USDC savings account will be paying 9% APY with no tiers on all balances. So check out Learn.io and learn how you can start earning the best interest rates on your favorite assets. So starting as we usually do with Bitcoin, we see that it was a very active and volatile week in most markets last week as investors continued to react to international and domestic news flow that is impacting markets. Bitcoin, as you can see, closed the week down 8.55% last week at closing at a price of $43,204. Now, from a technical standpoint, we see that Bitcoin did hold that 43,000, that key 43,000 support level. This blue line right here that we highlighted a few weeks ago. This is a positive sign from a technical standpoint as it closed right above this very important level that we had highlighted in the past. There are two strong narratives impacting markets right now. Mainly, the two of them are the U.S. Federal Reserve tapering its bond purchase program, and the other one is the ongoing collapse of Chinese property developer Evergrande, both of which we've been covering here. Additionally, the Chinese government seems to be intensifying its crackdown on the cryptocurrency industry. In today's Bitcoin section, we're going to tackle how the news from China is impacting Bitcoin, and we'll address the Fed and we'll address the Fed tapering in the S&P section later today. But first, let's dig into this China situation. So this is one of the articles that came out last week, as I'm sure many of you saw some of the headlines that the government of China essentially is announcing that it is banning all cryptocurrency transactions, declaring them illicit activity. This comes after the purge or pursuit against Bitcoin miners a few weeks ago. And then the government went on to say that Bitcoin and Tether are not fiat currency and cannot be circulated, end quote. This is reminiscent of China's previous technology bans. Let's go down memory lane for a second and see if we can find some clues as to what might come next. So a couple of highlights here, and just remembering or resurfacing some news that perhaps are not top of mind. So in late 2007, the Chinese government banned YouTube. In 2008, Youku, the Chinese equivalent of YouTube, was created. In July 2009, the Chinese government banned Facebook after a series of protests erupted in the country. In August 2008, Chinese Facebook, or Weibo, was created. In November 2012, the Chinese government banned Google. Although Baidu, or Chinese Google, had already been created in the year 2000, its stock price doubled within a year of Google being banned. In 2017, the Chinese government banned WhatsApp. Chinese WhatsApp, or Weibo, had already been created in August 2009, but took over the Chinese market after the WhatsApp ban. For many years now, the Chinese government has banned Bitcoin. And here is a headline from 2013. This, as you can see from the headline, this is from the BBC, and it's dated December 5th, 2013, and it reads, China bans banks from handling Bitcoin trade. Here is another headline from 2017. China's Bitcoin ban is no match for a stateless cryptocurrency market. This is a headline from Forbes on October 18th, 2017. And here is yet another headline from 2017 stating that China has banned ICOs. So we get the point that they are trying to ban Bitcoin and cryptocurrencies. The question is, what are they trying to build in order to create the Chinese Communist Party equivalent? And the article that follows may present some clues. As you can see, the headline from Arab News last week reads, China crypto crackdown reveals scale of digital yuan ambitions. If history rhymes, a push for the Chinese digital yuan should be in the cards very soon. The Chinese government might think that it will be able to replace Bitcoin and cryptocurrencies with its digital yuan. While this playbook may have worked in the case of Facebook, WhatsApp, Google, and YouTube, it may not work for Bitcoin and cryptocurrencies. There's a few reasons why. There's a few reasons why it won't work and why it hasn't been working for Bitcoin so far. For one, Facebook, WhatsApp, Google, and YouTube were all unique in that they had a choke point, their websites and apps. Nevertheless, many in China were still able to get around the ban by accessing these websites using VPNs. With Bitcoin and digital currencies, the Chinese government is up against a new type of technology. It is not just one app or one website. It is hundreds, if not thousands of websites and apps that allow Bitcoin to access Bitcoin. Moreover, it's not necessary to download a particular app or go to a particular website to transact with Bitcoin. A computer with an internet connection is all that is needed. In our opinion, the Chinese Communist Party will not be able to stop Bitcoin. And while the recent news has impacted price in a negative way, a look at the on-chain data reveals some fascinating insights. The data that you have on your screen is volume data from last Monday, September the 20th, the day that Bitcoin dropped almost 9%. And this basically shows us how from all the transactions that were being put through on the 20th, it basically shows us how long ago they had actually bought or transacted before, so that we can get a sense of how old were these holders, like how long had they been holding on to this Bitcoin before they went on to sell it. And it's no surprise that on-chain activity indicates that over 95% of the Bitcoin traded on September 20th had been purchased less than 3 months ago. In the context of the news that we just shared, this makes sense. The recent sellers are relatively new hodlers that have not been through a China bans Bitcoin cycle. Historically, buying Bitcoin when China bans it has paid dividends in the long run. So more on this in our What's Ahead section. Moving over to the S&P 500, we see that equity markets sold off last week heading into Tuesday's FOMC meeting, but found some comfort after Wednesday's statements, rallying to close the week higher. And just to highlight this on the daily, we see here essentially that here's the beginning of the week, Monday, Tuesday. Here is Wednesday, Thursday, Friday, essentially. So we see that the market sold off into the meeting. Once the comments came out from the meeting, it basically found its footing and was able to close last week higher by 93 base points at 4,459 points on the S&P. If we look at the NASDAQ closed last week barely higher. Essentially, the graph looks like it was a big move, but it actually just closed the week barely higher, or barely lower, actually, down 2 basis points from in the period of last week. And the Dow Jones, we see that closed the week higher by 62 base points at 34,798 points. Now, the big news out of last week was the Fed and its comments, as we mentioned, from the FOMC meeting. So although the Fed once again reinforced that it would start paring back its bond purchase program soon, Jerome Powell comforted markets by saying that policy would remain accommodative until the Fed's unemployment and inflation targets are reached. While we have more than overshot the inflation targets, the unemployment rate stubbornly remains at 5.2%, which is far from the Fed's target rate of 4.4%. The Fed and the market will likely place more and more emphasis in the labor market data going forward. Now, the Evergrande story out of China continues to impact markets, or continued to impact markets throughout last week. It'll likely continue impacting markets this week. Some of the headlines that we saw around this last week was that Evergrande actually failed to make a bond payment last Thursday. Now, the payment is not yet technically in default, as they have another 30 days to complete it, but it is an ominous sign of trouble. Among other headlines that came out on this topic was the fact that the Wall Street Journal wrote that China makes preparations for Evergrande's demise. And while some investors are talking about an imminent default, others argue that Evergrande is too big to fail and that the Chinese government will not allow Evergrande to collapse and bring down the real estate industry with it. Now, the Chinese economy is already in a fragile state, and there are other headlines, as you can see here from Asian markets, that state that there's an imminent China Evergrande deal that will see the Chinese Communist Party take control of the firm. Now, again, lots of moving pieces here, and markets could very well remain volatile until this situation resolves itself. Moving over to our analysis of gold markets, we see that before we get into gold, we see that bond yields actually soared after the Fed meeting, which pushed real return of Treasury bonds higher and made gold turn lower for the week. First, let's look at how high bond yields soared, and they're soaring again this morning. Last week they were finished. Last week the yield on the 10-year note in the U.S. Closed higher by 6.57%. This morning they're already up higher by 1.64% so far on Monday. The yield on the 30-year note was up 4.14%. This morning it's not materially higher this morning, or it's 20 basis points higher than when it closed on Friday. But again, the trend seems to be continuing. Now, as bond yields go higher and inflation stays relatively the same, the real return of these bonds go higher, which means that gold suffers. As we know, gold is negatively correlated to the real return of US Treasury bonds. So if we look at gold, we see that last week it actually had a slightly negative wick, down 20 basis points to close at $1,750 per ounce, essentially. Now, as we mentioned, this current macroeconomic backdrop is not favorable for gold unless inflation data surprises to the upside. It is all but certain that the Fed will start tapering its bond purchases, and as they stop buying, bond prices should go lower and bond yields should go higher. Gold, as you know, as we just mentioned, has a negative correlation with the real return of US Treasury bonds, which are poised to keep rising, and inflation seems to have peaked. This means that the real return of your US Treasury bonds should be underway up for the rest of the year. And this should strengthen the US dollar and put pressure on gold prices to finish the year. So interesting trend to keep in mind as we continue through fall and winter. Moving over to our analysis of DeFi and Ethereum, we see that the DeFi index closed last week down 10.47% after being down more than 20% at some point in the week. We see that Ethereum also finished the week down 7.95% at $3,064. But it is interesting to highlight that Ethereum did close over that psychologically important $3,000 level per Ethereum. And it was another wild week in NFT land with a headline that made waves in the entertainment industry, but did not have the same pickup in crypto media. And this was the fact that none other than Snoop Dogg revealed that he is behind a popular NFT Twitter account at Cosimo Medici, which has been engaging with the NFT community and actively participating in the conversations and in the markets. Snoop Dogg sharing his story will certainly drive more mainstream attention to the NFT space, and the trend for artists and athletes to get involved seems to be alive and well. Another news in the Ethereum front, we saw that an analyst from JP Morgan over the weekend wrote that investors are suddenly dumping Bitcoin for Ethereum amid $150 billion crypto price crash. Now, this headline is a little bit misleading as far as the content of the article itself. It reads that, if you read through the article in detail, it reads that the analysts wrote that the NFT activity was in part why some institutional investors had been rotating from Bitcoin futures and into Ethereum futures. It pointed at the futures versus spot premium on the Ethereum futures as a signal that institutional activity is healthier in that market at the moment. It's not necessarily healthier, so much so that there is more pent-up demand relative to the supply. So again, we're starting to see the future price of Ethereum become disconnected to the upside from the spot price of Ethereum, which typically means there's more institutional demand or more demand for that futures contract than there is currently available. So again, these tend to be a good forward-looking sign of institutional activity. Now, DeFi activity should also get a boost from the recent crackdown in China. We're seeing essentially notes and headlines circulating about DeFi exchanges volumes soaring as some of the local exchanges in China continue to essentially wind down their operations. As this happens, more and more Chinese clients that were trading on these exchanges will be looking for a new home to fulfill their needs. And most likely, or it's very likely that a lot of them will be finding DeFi platforms as part of resolving this need. So interesting, and we'll continue to monitor this trend. Moving over to the Bitcoin mining difficulty commentary, we see that not much has changed on this front, with the next difficulty adjustment projecting a moderate 1.1% increase in difficulty. In other notes around the mining space, mainstream media continues to write more favorably about Bitcoin mining, with recent articles pointing to the fact that they are acting in a more environmentally conscious way. An example is what you have behind your screen or on your screen right now from the Wall Street Journal last week, which essentially states that Bitcoin miners are eyeing nuclear power as environmental criticism mounts. Again, recent advances in flared gas mining, along with signals towards the use of nuclear energy, continue to get informed coverage around Bitcoin mining from the media. So this is encouraging to see. Checking in on the mempool, we see that mempool activity is still quite low. It's pretty optimal conditions for transactions in terms of price and speeds of confirmation. So it's a great time to transact on chain. Now, as always, we leave you with what's ahead for the week. To close, we wanted to highlight two events from the last week that could very well signal the continuation of two very important trends. And for this, I'm going to share the screen for a second. So as you can see from the article behind you, as governments like China literally chase the industry out of the country, others worldwide continue their campaign to develop and attract as much of the industry as possible. The most recent example is Dubai, as you can see from the article behind you. Numerous governments across the world are choosing to embrace this new technology rather than trying to stop or ban it. On that note, US Senator Pat Toomey said last week that China's crackdown, here's the article, China's crackdown on crypto represents a big opportunity for the United States. One country's trash is another country's treasure. Last week also gave us some great examples of how Bitcoin continues to weave its way into everyday life. One such example was the fact that Twitter or Bitcoin tips were included as a feature within social media giant platform Twitter. As you can see, Twitter rolled out Bitcoin tips for its clients via Lightning for some Mac iOS users through an integration with Strike. This is part of it turning its fans into funds strategy, and as it tries to essentially lure creators and become a hub for creators to interact. Twitter's 300 million monthly active users will soon be able to tip their favorite content creators worldwide in real time, paying virtually no fees. The team is also said to be exploring integrations for other digital assets for tips. Either way, by becoming the currency of social media, digital assets are one step closer to becoming the currency of the internet. Additionally, last week saw one of Netherlands' most renowned and historic soccer clubs, the PSV, announce that it holds Bitcoin on its balance sheet. And here's the headline for those of you who weren't able to catch it. Having Bitcoin and transacting with it is slowly becoming normalized. Whether you look at social media, governments, sports teams, billionaires, athletes, celebrity investors, publicly traded companies, and even politicians, the trend is clear. People are interested in what Bitcoin can do for their future. So, as always, we wrap up with a summary of the upcoming economic data that will be relevant for the week ahead. So, Monday, today is a bit quiet as far as economic data and Fed activity. On Tuesday at 9 a.m. Eastern, we get the S&P Case-Shiller Home Price Index. Expectations here are for an increase of 18.6% year over year. The market will likely cheer a lower number and sell if the number comes in higher than expected. At 10 a.m. Tuesday, we get U.S. Consumer Confidence Index. The index readings have been very strong lately, way over the 100 mark. Expectations for August are also north of 100 once again, and it will be interesting to see if U.S. consumers have started to shift some of their views from excitement to cautious. Again, markets might cheer a lower than expected number and sell off in a higher than expected number. Thursday, 8:30 a.m. Eastern, we get initial and continuing jobless claims in the U.S. As we covered earlier, the Fed will be very closely looking at the labor market. 8:30 a.m. Eastern, we also get U.S. GDP revision. So again, on Thursday, the Fed is closely watching the jobs market in the U.S. and any unexpected jump on unemployment benefits could hurt the pace of the economic recovery and hence force the Fed to continue being more accommodative. Similarly, with the US GDP revision, any positive economic data will cause the market to sell off, and any negative economic data should have the opposite effect. Again, this is because as negative data comes out, it forces the Fed to be more relaxed and accommodative. Friday, 8:30 a.m. Eastern, we get core inflation, and the expectation here is a 0.3 increase month over month basis. And on Friday as well at 10 a.m., we get the 5-year inflation expectation rate. And again, here the expectation is for 2.9%. And Friday will deliver two different views of inflation, and it allows us to exemplify the transitory inflation argument. At the core inflation level, which tracks month over month increases, the expectation is a 0.3% increase. If we annualize that, that means that the rate of inflation for the core inflation over the course of a year is 2.9%, essentially. If we annualize that rate, it's 3.6%. If we look at the rate of expectations for the 5-year inflation, that's sitting at 2.9%. So it's considerably lower. Current inflation is at 3.6, 5-year inflation is at 2.9. So even this 2.9 number is already significantly above the Fed's targets of 2%. So the Fed and the markets would both love to see inflation rates come down. If rates move higher, it could impact equity markets negatively, as the Fed might have to accelerate its tapering down timeline. So we've covered a lot. It's a big week coming up, and as always, we'll keep you relevant here, or we'll keep you posted here with any relevant information. If you learned something today, if you enjoyed the show, welcome you to like it, subscribe it, and share it with your friends. If you don't yet have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning up to 6.1% on your Bitcoin and up to 9% APY on your USDC. We also have the best rates on Bitcoin-backed loans. If you need cash but don't want to sell your stack, thank you, everybody. Have a wonderful week and see you next time.